Fed will cut interest rates next week, despite rising inflation. The U.S. Federal Reserve, Fed, sits at the center of global financial markets. Its decisions on interest rates ripple through stock prices, bond yields, currencies, commodities, and household borrowing costs. Next week, the Fed is widely expected to lower its benchmark interest rate, even though official inflation readings remain above the 2% target. Understanding why the Fed might ease policy despite high inflation requires a look at how central banks balance multiple objectives at once. Why the Fed raises or lowers rates. Interest rates are the Fed's primary policy tool. Higher rates make borrowing more expensive, which cools consumer spending and business investment, slowing inflation. Lower rates, by contrast, encourage credit, consumption, and investment, supporting growth and employment. In normal times, the Fed raises rates when inflation is too high and cuts rates when unemployment rises or economic activity slows, the current dilemma. At present, inflation is still running above the Fed's long-run target, but other indicators are flashing weakness. The latest jobs report showed slower hiring and a slight uptick in unemployment. Manufacturing surveys point to contraction, and credit conditions have tightened significantly for small and medium-sized businesses. Some forward-looking inflation indicators, such as commodity prices and market-based inflation expectations, have also cooled. These mixed signals create a difficult trade-off. If the Fed keeps rates too high for too long, it risks tipping the economy into a recession. If it cuts rates prematurely, inflation could reignite. Why a rate cut might happen now. Markets are betting that the Fed will prioritize financial stability and growth over inflation control in the near term. Several regional banks have reported rising loan losses, and the housing market has softened under the weight of higher mortgage rates. By cutting the policy rate even slightly, the Fed can ease pressure on credit markets and signal support for the broader economy. Officials may also believe that inflation is on a downward path and that a small cut will not reverse that progress. Another factor is the long and variable lag of monetary policy. Rate hikes implemented over the past 2 years are still working their way through the economy. By adjusting rates preemptively, the Fed hopes to avoid an unnecessarily sharp slowdown next year. What this means for markets and households. A rate cut would likely lower yields on government bonds and reduce borrowing costs for mortgages, auto loans, and business credit lines. Stock markets often react positively to easier monetary policy, especially interest-sensitive sectors like technology and housing. However, investors should remember that rate cuts during a period of high inflation can be a double-edged sword. If inflation stays elevated, real, inflation-adjusted, returns may erode. The big picture. The Fed's decision next week highlights the complexity of central banking. It is not a simple matter of fighting inflation or boosting growth. Policymakers must weigh both objectives simultaneously. Cutting rates while inflation remains above target is unusual, but not unprecedented. The move signals the Fed's view that the risks of economic slowdown and financial instability now outweigh the risk of persistently high inflation. For households and businesses, the key takeaway is to stay informed and plan for both scenarios: lower borrowing costs in the short run, but the possibility of renewed inflation pressures later on.